issues and sales and use tax, and with particular emphasis on the sale for resale exemption. We are faced in times of aggressive and inconsistent application by departments of revenue, and we see one state after another popping up and then going away, hopefully. But we do see different states making different moves in an attempt to collect revenue, sometimes with residents, sometimes with non-residents, attacking what is a normal, well-satisfied, legislated exemption that applies not just to airplanes but to everything, and inconsistently applying it and attempting to find ways to assert tax. And what might be a good model one day can change the next based on who's running the Department of Revenue or running for office or whatever. But our goal here is certainly not to talk about the political environment. It's to provide you background into what's happening throughout the country at any given moment, and particularly as it relates to the sale for resale exemption, to remind you that if there is another exemption available, and it's one that is aircraft specific, we will encourage you to use that. But when you're faced with an environment where we deal with general principles, including the sale for resale exemption, then we need to understand where that stands in the particular state. Now, obviously, we're doing business in all 50 states, and the state that's more aggressive today perhaps wasn't the one that was more aggressive last year, and it does shift in the wind. Nonetheless, we want to provide some general background, and this is not intended to be a substitute for you talking with your advisor. Whoever is your current legal advisor, the legal advisor assigned to your state. And, of course, if you want to talk to Suzanne, you can try and talk to me, but I will just refer you to Suzanne. She's much more knowledgeable than I am. But because you can certainly talk to anybody within the firm. But your advisor has specific knowledge about what's going on in your state. And so if you have a particular relationship with someone in the firm, I would encourage you to use that. And certainly you can talk with all of us whenever you think it's appropriate. Suzanne is on the forefront of this, besides being my daughter and being extremely intelligent. From an objective standpoint, knows more about this than me or anybody else outside this firm, because we're very much involved. We have a significant number of clients operating in any of the states, and so as soon as some state works on some project to raise revenue, we're typically the first ones to find out when it relates to aircraft. So I'm going to turn this over to Suzanne, and we're going to run through some general principles, and she's going to guide us through it, and you'll have an opportunity to ask questions as appropriate. But let's go ahead and begin. So, Suzanne, please take it over for us.
Great, thank you. I look forward to the opportunity of speaking with all of you this afternoon. I have worked directly with a few of you, I think, that are on the phone, either in IRS audits or in state sales and use tax audits. I do run the kind of litigation department of the firm, and I think in furtherance of the litigator in me, I'm going to move to our next slide and remind you all that this was by invitation only to advocate clients. If you are not a part of the group of advocate clients.
And let me inject one thing. If you're with the Department of Revenue, get off the phone.
That's what I meant. I should put it in my diplomatic form. If you're not an advocate client, we do consider it a breach of client confidentiality for you to remain on the phone. So I'd ask that you go ahead and hang up at this time. But for all of those clients on the phone, as we referred to, some of the exemptions that we use or elections that we work with in order to help minimize the sales or use tax exposure on aircraft are specific to aircraft, but many more of them are general to personal or business property in the state, including the sale for resale. And I think we're asking the question of whether all property should be taxed the same. That is, are we going to tax an aircraft in the same way that we're going to tax a pack of gum? And I ask this question in part because, as many of you know, aircraft are expensive property that are typically resold a number of times. And so is the same general treatment of charging 6 or 8 or 10% sales tax on the purchase when a company is going to lease the aircraft and then ultimately resell it, is that an appropriate approach to the taxation of property? And the truth is that sometimes sales and use tax laws distinguish and sometimes they don't. A few states recognize that aircraft are specific and have aircraft-specific exemptions. For example, there may be a common carrier exemption, which may apply to only 135 or airline operators, sometimes applies to 91 owners who place the aircraft on a charter certificate, although it's a very specific state by state and something you should talk to your advisor about if you might fall in that situation. Secondly, there might be a blanket aircraft exemption. Every once in a while, a state will make aircraft non-taxed, and one of the best examples of this is the state of Maine, which engaged in years-long battle over everybody who brought their plane into the state of Maine and litigated the issue all the way up to the Maine Supreme Court, only to about a couple weeks later pass a law saying that they didn't want to tax aircraft purchases at all because they wanted to be industry friendly. Seems a little bit ironic to us, but it's ultimately a good outcome for any of you who are going to purchase in Maine. But most states have not thought about aircraft sales and use tax specifically or passed any direct exemptions related to aircraft owners. So in most states and in most cases, sale for resale structures are the only way to argue against paying the 5 to 10% tax rate on the aircraft purchase price at the time of acquisition. So I think the advantages to the structure are clear. Most of you on the phone are using this type of structure where there is a lease agreement, and you would generally find that you're at least being provided the advantage of timing the tax over the life of the aircraft ownership, and if you sell that aircraft in a shorter period of time than you've recouped the lease stream tax, there can be a significant advantage. But as we tend to find in the tax business, the advantages of the structure are clear, but anytime you're not paying as much as the taxing authority could possibly get out of you, there might be some risk to the structure, especially in a situation where it's not aircraft specific. So I'm going to step back just a little bit, and this section is probably review for most of you. We're just going to talk a little bit about what the election is at this point. A sale for resale election is an election where state laws allow properly registered businesses to purchase property without paying sales tax, with the idea that the property is going to be held out for resale and not be used directly by the ownership company. For most of you, you have a single-purpose entity that owns or holds the aircraft and then provides the aircraft for lease to a main operating business, maybe multiple lessees, maybe to flight school students. But it's not the owner company that is actually using the property but for to provide it for releasing. Generally, in most states, a lease is considered a form of resale, and that definition may be found in the definition section of what does it mean to have a resale piece of property in the state. This allows the company to elect to remit tax on that lease stream rather than on the initial purchase of the aircraft. So how does the election work? Generally, the aircraft ownership entity has to obtain a resale certificate before the aircraft purchase, and that is something that we would help you with at the time of initial setup of the aircraft purchase. Next, the ownership entity, the actual LLC or partnership or S-Corp that owns the plane, will enter one or more lease agreements with aircraft operators at the time they take delivery. And generally, you will be instructed to enter those lease agreements or even enter amended lease agreements should they change outside of the state that the aircraft is ultimately operated in. And that can be significant if you are in a state that allows you to apportion those lease periods that occur within the state or the flights that are happening in your base state that you remit tax to and those that are happening outside of the state. Lease payments are calculated based upon usage, and many of you have different types of lease agreements based on your structure. That may be a monthly reporting, a quarterly reporting, or an annual reporting, depending on both the nature of your lease and the nature of the filing periods assigned by the state. And finally, lease payments, along with the sales tax on the flights, are collected from the lessee, and the tax is then remitted to the state by the lessor. And this piece of it's really important, and I think sometimes we make book entries for lease payments, or because there's a relationship between lessor and lessee that's a close one, the actual transfer of funds on the lease payments may not happen in an orderly fashion. And that is actually something important to use and to be able to show the state in the event of the audit that this is being treated like a real document. It is a contract that's being followed. Those are the basics on how the election works. And as we've alluded to, there are many reasons to use the election. It's long been an effective tax planning strategy for aircraft purchases, given the structure commonly used, which places the aircraft in a single-purpose entity, as we've discussed, and makes a lease either legally required or sometimes otherwise advisable. That is, those of you with larger aircraft may have a truth in leasing requirement by the FAA that agreement be in place. Generally, even if you don't fall under truth in leasing for aircraft, it's advisable to have an agreement that shows the clear transfer of operational control of the aircraft and can protect you in situations for liability, especially if you are not the one, or the owner of the ownership entity is not the one that's piloting the aircraft. And secondly, it allows the tax to be paid over time, and when the aircraft's only owned for a few years, it can lead to substantial tax savings. So are there risks to making the election? Well, taxing authorities tend to have the attitude that they're more likely to conduct an audit of the sales and use tax when the tax is not paid on purchase. Some of you may have previously received a notice inquiring from you saying, hey, we've looked at the FAA registry, we know you own a plane, please provide us a copy of the bill paying for the aircraft and showing that you paid sales tax. Well, that's really easy to answer if you have a bill where you paid purchase price sales tax. It gets a little bit more complicated when you're required to prove up the exemption or the election. And in most states, proving up an exemption or election is the burden of the taxpayer. Now, that's also why you hired us, and we're more than happy to help you through that process. But, my personal opinion is that anytime you're making an election that is not 100% clearly applied to aircraft in state law, that there's some risk. And the second point on this is that from time to time, taxing officials make internal policy changes in the way that they read the exemption, which can lead to retroactive application of purchase price tax, interest, and penalties. What does that mean? That means that it's kind of hard to get legislatures to pass a law saying this general resale election, it doesn't apply to planes, or we didn't need for it to apply to aircraft. As in your legislature, there might be folks who answer to constituents and care about the aviation industry and are knowledgeable about it. But when there's any kind of gray area, you may have someone who starts at the taxing department and thinks this isn't what sale for resale was meant for, and they can make an internal policy change or change the way that they read it internally, and this can lead to a lot of difficulty at the administrative level. And they can sometimes force taxpayers in a situation where the only way that they could resolve the issue is going through costly and annoying litigation beyond the administrative level in order to get a real answer on the question of law. Now, certainly we want you to be aware of this risk. I can say that generally for our clients who have been properly registered for the tax and can prove up the lease stream, in most states they're completely fine. When there's an internal policy change, it tends to not be a situation where ultimately they would end up paying a penalty, but it can be costly and annoying and stressful. And sometimes an administrative level judge can make a finding that the purchase price tax is actually due on the initial aircraft purchase. So why are states challenging these structures? Well, not to be too cynical, but the way we could draw you a map of the United States to talk to you about when and the timing of various times that states have really jumped on this issue, and it is directly related to the financial well-being of the state in question. And the timing looks really suspicious that this is primarily driven by the need for state and local governments to get more revenues without having to go through the trouble of actually changing what the law says or creating a new tax on businesses. As I mentioned, changing the law is hard, but internal policy changes about how they're going to read the law or apply it to a finite group of taxpayers aren't always difficult. In some of these states, and I think I have one of my clients on the phone who's in one of the Dakotas, and in some of the states there are 2 or 3 revenue individuals who really run the show, and that we know and we work with very well. But in some of the larger states, they can put together special teams whose entire job is to try to go after corporate aircraft and make sure that they're maximizing tax liability there. And, state taxing officials get together. They have annual conferences to discuss revenue sources and collection strategies. Aircraft have been a recent target based on the political climate surrounding corporate aircraft. We certainly saw a shift in both the treatment or the initial audit notices by both the IRS and the states right after the big crunch of 2008 and the infamous taking of the GM corporate jets to Washington to testify for a bailout. That was not a good moment for the private aircraft industry, and it really has residual effects among the government employees that do this type of work and are focused on collecting tax revenue. So why do states challenge the structure, or how substantively do they challenge the structure? Well, a lot of you are in leasing relationships to companies of common ownership, and we know that state law treats those as separate companies, but in looking at these transactions, they may raise eyebrows by state revenue agents as being not what the exemption was intended for. Now, for those of you who are leasing through a flight school to multiple users, this argument obviously, or this concern, I don't know that it's actually that valid of a legal argument because the law itself doesn't distinguish here. But certainly this is the type of thing that may raise eyebrows if someone has an aggressive attitude towards state tax collection. Examiners may look at it merely as money moving from one pocket to the other, or may just subjectively view this as not being what the retailer's exemption was originally intended for. So what basis are they going to use to challenge the election? Well, they may argue that the intent behind the election wasn't to allow these kind of payments between companies of common ownership. They may posit that a company with a single lessee that doesn't advertise or make the property available to the public isn't in the business of leasing and therefore is not entitled to the election. And these type of arguments can be made in situations where folks who know things about aircraft or the industry know that you wouldn't put an ad in your local newspaper just to rent your plane, saying, I've got a King Air if you want to use it. But those outside of the industry may think that you have an obligation or that this may be an issue that makes them think that you're not a general reseller. They also may argue that the rental rate isn't high enough for them to gain the tax revenue that they were intending to receive under the election. And generally, taxing authorities are given substantial power to enforce and collect tax. So they can make it difficult or costly to challenge their assessments and can sometimes use aggressive tactics in that regard. Just as a matter of example of some of the challenges that we've seen in states, in 2004 and 2005, the state of Indiana went on a rampage a little bit over aircraft that were being used for leasing, regardless of whether or not there was a related ownership issue, although for most leasing structure there is a related ownership issue or related ownership between lessor and lessee. This led to a firestorm in the state of Indiana of aggressive collection techniques and ultimately led to Indiana conceding that the related party piece of it was not important, but passing a statutory rate by which your lease receipts have to be X amount a year in order to make the election. Now Indiana law is very clear. It's a statutory rate that is applied to aircraft leasing structures, and folks have notice of that. This has been a situation where some of our clients did end up ultimately paying tax and interest and penalties and ultimately filing refund claims in the court and are now getting refunds for a lot of what they paid. with Indiana kind of conceding that it was an aggressive move by the original taxing authority, but that ultimately they got what they wanted in the legislation. And we at least got clarity in what the law requires from our clients. Tennessee also challenged a related party leasing structure and went on through litigation for several years. It was a client of our firm. The issue went all the way up to the Tennessee Supreme Court and ultimately went back to the trial court, and the taxpayer won at trial. So there's some good law in the books in the state of Tennessee, but Tennessee is not too thrilled that they lost, and so they continue to take a close look at sale for resale exemption structures, at the way the lease is written, and at making sure that the structure is being followed to the T, because they're looking for another opening to challenge the exemption again. And finally, the state of Texas. Many of you may have heard through the grapevine that Texas has been, since 2008, determined to collect purchase price tax, penalties, and interest on every aircraft purchase that touches the state of Texas retroactive to the year 2003. This has affected thousands of aircraft transactions, and the challenging to the leasing structures have been all over the place. That is, they advance one legal theory and lose on that theory, so they just turn around and advance a different legal theory. And they're still hard at work in filing, challenging all lawsuits for refund claims that are being filed in the state of Texas. And this is an example of a state that was one of the most aircraft-friendly states, and that had written administrative level decisions on the books, blessing the structure between related companies, blessing the lease rates between related companies, and then they had a change in personnel, and they attended a conference, and then suddenly they took an about-face on how it applies to aircraft. So, of course, the build-up to all of this is the question what you can do to avoid an assessment. And I think that this is one of these moments where you're going to be incredibly annoyed by the fact that I'm a lawyer. Because this is going to feel really lawyery. And let me tell you that all I can say is that I can't tell you how much I wish that there was certainty. I spend my time arguing with state taxing authorities across the country, many of them whom I have great working relationships with, but this kind of lack of certainty or shifting what the game is all the time is frustrating for us as well. The best we can do is try to stay on top of it and keep our finger on the pulse. But what I can definitely tell you to do is that make sure that you pay attention to what's in those lease agreements that you initially signed, and that you're making timely payments and remitting the sales tax. Keep records of that activity. So if you write a check, make sure that you have an electronic check or a copy of that check on record or register. Keep a copy of the accepted sales tax filing, because they can reach back. And so having all of those records in order can make the experience of an audit much less unpleasant, and it's really essential to showing that the exemption is being taken seriously. Second, if you're selling an aircraft that you purchased under a resale election, make sure that you don't forget to give us a call then, and you get guidance from your advisor about any sales or use tax obligations you have as a seller, and retain all the sales paperwork. This is a reminder that when you make this kind of election, you are making the assertion to the state that you're in the business of reselling property. And that can create obligations on you. That is, you're not a casual seller at the time that you sell the plane. And when a plane is sold, often there's a temptation to think, okay, well, the aircraft stuff is over. And when states can't collect from the purchaser, they may go to the seller. And especially if the seller is a registered seller, they may feel it's easier to go to you. Now, this is the kind of situation where good paperwork can answer the claim incredibly quickly. But knowing what that paperwork is, it's an important moment to talk to your advisor here and let us walk you through that process. And finally, beyond following the structure, it is pretty difficult to know what may satisfy a given taxing authority should a shift in policy occur. As I mentioned, in Texas, there was a prior legal ruling endorsing the structure before the state just reversed its own position and began holding that the election doesn't work. Even taxpayers that remain faithful to the requirements of the election and operated based on prior rulings have been assessed tax. Now, before you have a heart attack over this, I will say that in those situations, the state has been giving credit against the purchase price tax for all the tax that was been remitted over time on the lease stream. Many of those situations, they've agreed to a waiver of any interest on the initial tax. Generally, they have not assessed penalties so long as they relied on an advisor in setting up the structure initially. But sometimes you just don't see it coming when it's done by internal policy change. Often we're asked the question of, well, should I increase my lease rate? And will that give me additional protection in the state? And it's an understandable question, and it might. Sometimes it will. That is, if the state sees a lot of money coming in on the use tax returns, maybe they're less likely to pick you for an audit. But states that choose to attack the structure may attack it entirely as subverting the intent of the reseller's exemption. And this could create a conundrum for owners who increase their lease rates without realizing any real benefit. That is, in most of the states, and definitely most of the states that you all are located in, they send us an inquiry form about the exemption, we provide a copy of the lease agreement, and the state goes away and closes out the file. So creating a really high lease rate, you do run the risk of paying a lot of additional tax on that lease stream without seeing any real benefit from taking on that step. And every once in a while, a state will have a situation where the law specifically does not allow for a credit against the purchase price tax in the event that they find you owing for purchase price tax. And it would be a bad situation to pay higher on the lease rate and also owe on the purchase. So, kind of absent paying purchase price tax, there's no guaranteed way to avoid a challenge to the applicability of the assessment. As an engaged client, we'll defend you through the administrative level, but we can't ever guarantee that a state will not pursue tax. So I'm going to go now to just a summary of some of the things we talked about today, and then I'll take a look and see if we have any questions from any of you that I might be able to answer. First, the election to pay sales or use tax on the rental receipts from aircraft leasing rather than on the initial aircraft purchase can be a useful and helpful way to control sales and use tax, and is often the best approach available for an aircraft owner. Because the election may substantially decrease tax revenues, states on occasion challenge the election. As we mentioned previously, because we have a large market share of aircraft owners who are in your situation, we are often the first to know. That is, I know many of the taxing authority individuals by first name, and I know about their kids and where they go to school and all of those things, and I work quite well with them. They are familiar with working with us and working with our firm. And we do see it as our obligation to keep you informed if we see something happening in your state. But situations change, and your ownership situations change. Your profile of use of your aircraft may change. That is, when you initially purchased it, you might have been mostly using it in one state with no significant use in any other state, and that may have changed. You may have a state that you now have a customer in that you're regularly traveling to. Please let us know. States are also expanding the concept of what it means to have nexus. That is, which aircraft owners can they try to collect tax from? And there was a recent decision alluding to the kind of NetJet situation in California, where the California courts held that between 9 to 12% of the use in the state of California was enough to confer constitutional nexus on the state of California to collect tax on the full purchase price of the entire fleet of aircraft. So we just need to be careful. It doesn't mean that we can't set up an exemption in another state. It doesn't mean that your state or the state that you're going into won't honor the streamlined sales tax project. But without you letting us know changes of where you're traveling, or not letting us know until the year end when we see that flight log, it can put us in a situation where we're just a couple of steps behind. And if I've learned anything in this, it's that being a couple of steps ahead and knowing a little bit more about this than anybody else on the other side of the phone has really helped serve our clients well in those situations where they faced an audit. So I know you all know who we are and you know how to reach us. As Lou initially said, I am the litigation director for the firm here, so I talk to the IRS and state taxing authorities all of the time, and I don't see any questions that have been typed in yet, but certainly if you have questions after the presentation for myself or for Lou, I'm more than happy to answer those. Your personal legal advisor who works with you on a day-to-day basis likely knows more about you and your structure than I do, unless you're a client I've worked really closely with, and they may be able to best help you put the plan into action that protects you or attempts to protect you and best protects you from liability for sales or use tax in other states. I'm going to just take one more check and give you another minute if any of y'all have any questions to go ahead and type those in. And as you will see, the lawyer in us once again at the end of this is giving the IRS required disclaimer that it's the situation that this is a general overview of tax developments and is not specific tax advice to your situation or how provisions may apply to a specific situation. So feel free to talk to us about what we can do to help you and things that we can be aware of in your structure to really try to minimize your liability in this situation. Okay, I'm still not seeing any questions at this time, so I'm going to thank you all for your time and energy today. Oh, I see one. And I see a question about if there have been challenges to leaseback owners in the state of Florida this year. Florida has generally, and knock on wood, everybody on the phone who's Florida-based, but Florida has generally been relatively easy to work with on sales and use tax cases. There are individual auditors in Florida who have raised issues regarding apportionment of the lease stream. I think where our Florida clients want to be the most careful, especially in leaseback structures, is to make sure that if you're not the one collecting or remitting the tax to the state, that is, if it's the flight school that collects and remits the tax when they're renting your plane, make sure they're doing it. Sometimes flight schools have an understanding of the law that's a little bit off. That is, a flight school can purchase a plane in some states and not pay on the lease stream if they're providing just instruction, or pay on the purchase and not on the receipt. So they may have confusion about which flights they needed to collect tax on. We are also happy to be a part of that conversation with the flight school if they're not doing things correctly so that it doesn't put you in a situation that's uncomfortable. But generally, in a flight school setup in the state of Florida, we have not had any trouble defending those exemptions. And in related party leasing questions in Florida, the questions have been more finite. There's been specifically about the apportionment of flights, and most of our Florida audits are absolute no changes. The apportionment question is kind of still in the middle of administrative review. I see a question now about if Florida is still taking tail numbers and following up on sales tax. There was a big controversy where the state of Florida was writing down tail numbers at Sun and Fun for all you who flew in to see if you paid tax somewhere and see if they could collect the tax. Our circumstantial evidence of that, well, we've been told by the department that they don't do that. That said, we were told by the department they don't do that when they were doing it. AOPA got involved. Our firm got very heavily involved in trying to explain to them why this was a terrible idea. We do not believe that they're still engaging in this practice. I don't believe we've received a single Florida notice this year on any client on sales and use tax. There's an initial form you file in Florida, and we have been able to satisfy the state of Florida on the initial filing for the last couple of years. And so I'm not too concerned about the temperature in Florida right now. I see a question now about challenges in Louisiana. And Louisiana is its own kind of beast because the state and the parish tax are separate. Louisiana did a few challenges a few years ago. We appealed those, and they don't seem to have an internal mechanism for hearing appeals, so they somewhat disappeared. Every once in a while, we have the state taxing authority will clear the exemption, but the parish will require additional information as a taxing authority. But we have not been in a situation in Louisiana to actually establish that they're not accepting the structure. And most of the time when we provide audit information in Louisiana, it's just accepted and the file is closed. And on the question about how can you make sure your flight school is collecting and remitting tax, most of those who are doing it correctly should be able to show you on your monthly invoicing any tax that was collected and remitted on behalf of your aircraft. A lot of flight schools just keep a separate spreadsheet that shows in number by in number. And again, if you have any more questions about this, we may know your flight school, and it might be the easiest thing for you to contact your advisor, and we can give them a call and make sure that they're doing things correctly. And I see another note about some Florida flight schools refusing to collect sales tax on instructional flights, no matter whose aircraft they're using. Are they in violation of the state rules? That's a tricky question. They may not believe they're violating state rules, but they could be jeopardizing your exemption. And generally what we can do in this situation if they refuse to collect is they can let you know how many of those hours for your aircraft were for instructional purposes and what the rate charge for the aircraft piece of it was, and you can report tax on that small amount of the rentals under your reseller's permit. But it is a situation where if your flight school is putting you in a situation where they're saying, we're just not going to collect because we don't have to collect on those flights, they may not be violating the law themselves, but they are jeopardizing your exemption because you're not providing the plane for flight instruction. You're providing the plane for rental or lease that is then being used by the flight school for flight instruction. And this is the area that confuses flight schools and can lead to tension there. I see a question about if nonprofits are exempt in any way, if they're using aircraft. If a nonprofit is generally exempt from leasing property and they are the lessee of the aircraft, they may not owe tax on that transaction. Generally what we would encourage you to do as the ownership entity, though, reporting the tax, is to report the lease income on the return as exempt sales. That is, don't pretend that the activity never occurred, but have the owner get a copy of the exempt status certificate of the exempt lessee or lessor and keep it on file and report those as exempt sales to the state. The truth is I don't know specifically about Georgia what that provision looks like, and your advisor can help you on that, but our general advice on if you're leasing to someone who doesn't pay sales tax on lease agreements, make sure that you have in your files their exemption. I see a question about whether there are known issues in the state of West Virginia, and I can say that that's one of the states that I don't know the folks in West Virginia, and that's always a good sign. So nobody in West Virginia has ever talked to me, and we find that to be a good thing because we do have West Virginia clients. So good news there. And the current tax election challenge climate in Wisconsin is our next question. And many of you in Wisconsin have probably been made aware of the fact that Wisconsin recently changed the structure that they require in sale for resale purchases dating forward from a certain date, in that you couldn't have a parent subsidiary lease. That you need the lease agreement to be what we call brother-sister between two taxpayers that one is not wholly owned by another. We have been following those provisions very closely. If you fall into that situation where you're not grandfathered in, I can guarantee that your lease agreements are following the appropriate structure. And our situation in Wisconsin has been that they've checked up on the structures a little bit, but we haven't had any claims of imposition of tax on the purchase in the state of Wisconsin. The states that I would kind of give you to heed a warning to, if you are not based there, or if you're based there, or if you travel frequently to or fro, would be that the hot button states for us right now are the state of Texas is the number one, and the state of Michigan are both aggressively challenging these. And those challenges have been happening over the course of the last couple of years. we did realize that Ohio just came online to the FAA database. That is, they've just gotten access to the mailing addresses. We don't know why it took them this long, but of all of registered aircraft FAA owners. So a lot of our Ohio clients have recently received a notice asking them what the exemption is, but we haven't, as long as it's been timely returned, we haven't had any follow-up concern about the election or exemption. So those are the best comments I can make about climates in individual states. And we do kind of hope to keep you on the forefront if we start to notice something brewing in a state. As was alluded to earlier, Florida was up in arms a couple of years ago, and that has really died down. And we have found in situations, and remain hopeful both in Michigan and Texas, that the bad thing about trying to change policy internally by one individual is there is not an awareness of what constituents want and how important the industry is in the state. And so you end up in situations like Maine, where the state spends a ton of money trying to challenge the exemption and then ultimately ends up making all aircraft exempt. And so, you know, in the state of Florida, I think what really happened is they thought it would be a great way to make money until they realized it was a terrible idea, that aviation is very important in Florida, and that the second most important thing, or the very most important thing actually in the state of Florida, is tourism. And if people are too afraid to bring their planes here because they're going to end up paying tax on the purchase price of their planes, that they're losing a lot more money than they're gaining. But it can be a painful process as it's going along, and we want to insulate you from that pain as much as possible. Okay, we're almost reaching the kind of 45-minute marker. If we have any other questions, though, I'm happy to answer those. And I have Lou here with me as well if anybody has any questions for him.
Well, we appreciate your time, and if something does come up, feel free to send us an email. Talk with your advisor or talk with us. We're more than happy to help you, and particularly in these areas where nobody really knows what the environment's going to be tomorrow. Stay in close contact. We will make every effort to keep you aware of any changes such as the Wisconsin thing that Suze was just talking about. We appreciate having an opportunity to serve you. Take advantage of the fact that we don't charge you by the minute. Give us a call when something's on your mind. Thank you for your time.
The leader has disconnected. The conference will be terminated in 2 minutes. The leader has turned lecture off, and your lines have been unmuted.